Hello and welcome to Bloomberg Quint. My guest today is Rohit Sipahimalani, who is the Joint Head India of TEMASEK. Rohit, thank you for joining us on Bloomberg Quint. It's been a good year for TEMASEK in terms of returns, nearly 13.4% returns as a whole, and that's the highest in 3 years, right?
Well, year before last we had a 19% return. But about 60% of our portfolio is listed. So our performance is never completely divorced from that of the markets. So we were helped by the fact that markets also did well in the last year. So for us, the year-to-year volatility is not something that we're that focused on. Year-to-year numbers will vary with the markets. For us, what's more important is really returns over the longer-term period that can be sustained, which one would like to be better than the markets, but more importantly should be better than our own cost of capital and our own hurdle rates.
Mm-hmm.
And in that area is actually where we're pleased because we started reshaping our portfolio in 2011.
Yeah.
And that has been showing good results, and which we think will continue to give us sustained returns over the long run.
I was going through the TEMASEK review and a couple of interesting facts came in there. One, you believe that the returns from unlisted space is much higher than the listed space. That gives away the thing that we are in a high valuation zone or in a bubble zone. What is your view there?
So firstly, our own experience has been that unlisted returns have given us over the last 10-15 years better returns than listed companies, and you would expect that because you would expect an illiquidity premium when you're investing in an unlisted company. But more generally on valuations, the point that you raised, yes, valuations are well above average across all major markets globally, and that's a function of today's low interest rate environment, but it's also a function over the last 8 or 9 months of a global economic recovery you've been seeing across all markets. So I think this year, after 2 sluggish years, you're actually seeing double-digit earnings growth being projected for all major markets.
Mm-hmm.
All those things supporting valuations.
Yeah.
Going forward, as rate normalization happens, I think it's reasonable to expect some multiple contraction. To the extent the economic recovery continues, we would expect the earnings growth should offset that. But I think that's really the risk that people are concerned about.
That's an interesting point you spoke about, that double-digit earnings growth for developed economies. We're starting India with double-digit expectations, but interest rates are going to go up in developed markets, while there's a view in India that interest rates has to go down here. How do you see that panning out for the Indian universe where you have a significant exposure, right?
Yeah. So it's a good point that you're making, and one of the reasons why, generally speaking, even in the current world, we are more constructive towards emerging markets right now is because a lot of emerging markets went through a lot of pain over the last 5 years. And I've gone through, some of them have gone, like India, I've gone through also a lot of good structural reform, and the macro position is much better today than it's been in the past. Secondly, as you said, in a lot of places like a lot of developed markets, you have negative real interest rates, whereas actually real interest rates in a lot of emerging markets, including whether it's Mexico, or Indonesia, or India, are actually quite high. You have 2 to 3% real interest rates. So actually you have policy flexibility to reduce rates, which may actually provide a fillip to growth. So overall on that basis, I think we are more constructive in the near term because of starting point of valuations, as well as the policy flexibility that emerging markets have where their current starting point is. We're actually more constructive in emerging markets in the near future compared to developed markets.
What is the kind of exposure you have in India?
So it's 5% of our overall portfolio.
That's around 10 to 11 billion dollars, Singapore dollars.
Well, our that would
227,
be
240, yeah, little more than that. There's a significant shift in the allocation as well. Last year, telecommunications and TMT was the highest sector for you. This year, it's the other way around. It's the financial services sector, which is the highest 25% coming in from there. TMT going back to 23%. It's almost a reversal which has happened there. That's primarily maybe because of Bharti, you exiting Bharti and getting into telecom other place, and in your increased exposure to India with respect to SBI Life and others, right?
So the percentages that you're talking about, telecom versus financial services, that's with respect to our global portfolio. 2 years ago, actually, financial services was the largest and telecom was number 2. Last year, that flipped, partly because of the decline in value of a lot of banks that you saw, year ended March 16 globally. A lot of those values rebounded back in March 17.
Okay.
So actually, in some sense, it's just a rebalancing there.
Of valuation, basically.
Valuation, and I think it's just over a 2-year period, there's no real big change between financial services and telecom. I think what has changed globally also is the mix both within financial services and within TMT. Within financial services, we have a greater weight towards non-bank financial services like payment companies, insurance, etc. We've seen that in India too with our investments in the insurance companies. And in telecom, media and technology, there's been a greater shift towards technology with a lot more incremental investments being there. So that's a conscious shift that's been happening. Within India, yes, we, Bharti was a part of our portfolio a year earlier. It's not right now. But that was really, we sold that to Singtel.
Yeah.
So we still retain our economic exposure with the company.
So if you look at India exposure, what would be the highest exposure sector for you?
We don't report that officially, but if you just look at our various companies that we have in our portfolio, financial services would also be the largest sector for us in India.
I also wanted to understand the shift from Bharti Airtel, and it's given you good returns over the years, but you try to get an exposure on an economic level from Singtel onwards rather than being directly invested. Is the hyper competitive environment in India with respect to telecom one of the reasons for that?
So our investment in Bharti Airtel, Bharti Telecom, was as a financial investor, and we've been in that investments for almost 10 years. Over a period of time, I think when we looked at it, Singtel as a part of its own strategy had indicated that they wanted to increase the stake in their various affiliates. So it wasn't just a question of just Bharti in India. We were having an overall discussion with them about our stake in InTouch in Thailand, Bharti in India, and assets like that. And as a package, we both negotiated a deal which was in their interest, in line with their strategy, and also, met sort of our requirements. So that was just a part of that.
But how do you see the hyper competitive environment? Because since for 10 years you had direct exposure to telecom in India, and you've exited as a direct, and you're now indirectly as in form of economic interest.
But that, whether it's direct or indirect, doesn't really matter that much for us. It's the economic interest. We're not really looking at our voting
How
rights.
do you see the industry?
The industry obviously is going through a major change. I think we did have a number of telecom operators, more than probably was warranted, because of which you had a very difficult environment, over the last decade. I think the consolidation that you're seeing in the industry, is positive for the industry. You clearly are seeing one new entrant out there, which is again changing the industry dynamics. But ultimately, we see a more consolidated industry in telecom in India, which I think would be more sustainable for the long run.
Some of the changes that happened during the year was your stake in SBI Life. Now that's going to an IPO as well in the next 6 to 8 months. You have Crompton Greaves, which you picked up, and then you have increased your stake in HDFC Bank as well. Crompton Greaves is one of the consumer element, and I know Temasek has been telling, means you've been focusing on companies which are looking at consumer or middle class income there. How are you seeing some of the latest development that has happened with whether it's demonetization or GST playing out for this consumer sector?
So I'll make a distinction between the two. I mean, demonetization was an exercise that went through to achieve certain objectives.
It did impact consumer.
It did, but it impacted it for a few months, right? And so as you think about the longer run, frankly, I don't really think it's sort of going to impact consumption. In fact, you're seeing it come back already. GST is a more structural change. And I think it's something we're very positive about. It's something that we've been looking forward to for a while. I think we're very pleased that it has been implemented. Because I think structurally it will, it will improve the efficiency of the economy and also will be very good for the organized sector.
As part of the Temasek review, I wanted to come back to the unlisted space question, because that's an area where you will be looking at more, because it gives you more return over a period of time as compared to a listed space where the valuations are already running high and it's difficult to get significant exposure, let me put it this way. Which are the sectors which looks very attractive to you in the unlisted space? I know you have been telling us about financial services, consumer durables, but you have been very choosy in your investments, if I can use the word. We haven't seen you as aggressive as other private equity players in India.
Well, we've been, I would say, over the last 5 years, we've invested over $1 billion a year on average, right? So I think, I won't look at a period of 6 months or 9 months. If you just look at the last 5 years, we have been very active, and I think one of the most active players out here. I think in terms of just coming back to your listed, unlisted, I think it's a matter of where you are in the cycle, right? There's no strategy saying we have to do more unlisted or we're going to do more listed. In the last year, when valuations were high in the public markets, we did a little more of the unlisted companies. You mentioned SBI Life, for example. But post demonetization, when there was a correction in the markets, we actually went and were quite active in the public markets at that time. So ultimately, it's a question of where we see value. We don't have a preconceived notion that we want to do more listed or unlisted. But there will be times, if you have a prolonged period when the public markets are very expensive, it's natural we'll do more in the private markets. But when there are corrections out there, I think we're nimble enough to go and sort of be active in the public markets.
Another area where you've been bullish was the e-commerce sector. You have exposure to Alibaba. In the last 2 years, you've been reducing your exposure to by a small amount, if I'm not wrong. In India, you have Snapdeal. What's happening there? You said Snapdeal's business model was much better than Flipkart's, and today we are looking at Snapdeal getting merged into Flipkart.
So just stepping back, I mean, e-commerce as a sector, we continue to be pretty positive about globally. If you take Alibaba, for example, it continues to be one of our largest holdings in our portfolio and has done very well for us. We also invested in Lazada in Southeast Asia. We have a stake in Amazon in the US. So structurally, we are positive about the e-commerce story. In India, we also think that e-commerce has a very long runway. Our strategy in investing in early stage companies in a sector we find attractive usually is to come in with a small stake, which we did in Snapdeal a few years ago. And then really double down on ones that we see as to be winners in the space, because this is a sector where the winners will take a large share of the pie. The one most important thing for us in the e-commerce sector is a company should have a path to profitability, because that's the only way it's going to be sustainable. And I think that's what we're sort of looking at. We think the winners are those who will have that. And I think basically the winners are ones which we will look to see we can get exposure to directly in India or indirectly through our global companies.
So what went wrong, as an expert who has looked at the e-commerce sector, what went wrong with the Indian e-commerce industry? Now, where did it go wrong? I know at the end of the day you will look at cash flows, you look at profitability, but something went wrong somewhere, right?
I wouldn't say something went wrong. I think there was a lot of investment made to build up the e-commerce ecosystem. I think there was a period where in that whole process, growth became the most important thing. And I think there was a period through which maybe the visibility or the path to profitability became relatively less important. I think that's okay if companies go through for a short period of time. But ultimately, I think in any sector, anywhere in the world, companies need to have a path to profitability. You just can't have growth in the absence of that. And I think it's a phase that the market is going through. I think long run e-commerce will be very successful in India, just as it has been in a number of other markets. We are still very early in the innings out here. It's a question of execution and who the winners come out to be out here.
And you're willing to go double down if the consolidation happens in the industry?
Yeah, we will look at each individual opportunity, what the valuations are, how confident we are about the prospects, and based on that we'll make an investment call. But structurally, we continue to like e-commerce as a sector.
As we look at it today, there's going to be three players in the market. You have Flipkart, you have Amazon, and then Alibaba coming through Paytm Mall. You see ecosystem with three players good enough, or is it too competitive again?
So ultimately, I don't think there's a market. There's definitely place for more than one player, for sure. I think there will also be placed, as in every market, for niche players across certain verticals or certain areas.
That would be there, but profitability will be a good question there,
So look, ultimately it's got to be execution. It's the company's strategy. There can be different strategies which get you to profitability. And I think, look, we'll just have to see how things play out.
But it's a three-player market, you think?
Tough to say whether it's a two-player or a three-player market. in terms of the leading players with the majority of the market share out there.
I've been talking to you for last 3-4 years, and you've been bullish on the India's infrastructure sector, but we haven't seen much of investment coming through into infrastructure from Temasek. Why is that?
So I think we've always said that our main focus in India continues to be around the themes of consumption, whether it is in the financial services area or where also there's a consumer side to it, or FMCG or healthcare services. And we've said there's certain areas where India has had competitive advantages and we can see global champions emerging, which are areas like pharma or technology. And then beyond that, in the last couple of years, we've been looking at technology as an enabler across businesses. So that is consistent with our global strategy, and that's what we've been doing in India. I mean, infrastructure even globally is not a focus area for us. And these are the areas in line with the themes. Having said that, if there are specific opportunities, we'll look at that. We've invested in the port sector in India, and we continue to look at other opportunities.
One of the structural shift happening in India is in the real estate sector. You have RERA coming in, you have lots of regulations which are coming in around it, and that's creating a structural framework for the sector. And we're going to see consolidation happening in this in this sector. Is that a sector that you're looking at actively in that sense? Are you have you noticed that this is going to be a structural shift which going to happen for the real estate sector in that sense?
I would say, broadly across, whether it's real estate, other forms of infrastructure, whatever else, there's a lot of operational involvement required out there. And there are areas where we have our portfolio companies in Singapore where we have often majority stakes. A lot of them are actually active in these areas,
yes,
and in the last few years have become more active in India.
True.
So when I look at the infrastructure of the real estate space, we will also look at opportunities, but I would expect that a greater thrust will come from our portfolio companies. So whether it's Ascender Singbridge in the real estate sector,
Semcorp
in whether it's in
energy,
infrastructure, energy. They also, together with Sarbana, have been with Ascender Singbridge are looking at Amravati in terms of developing the startup area out there. So we have a lot of our companies that are actually quite involved. PSA is involved in the port sector in India. So I would expect that the whole infrastructure area, real estate and related areas where there is a lot more operational intensity and involvement required, I would expect our portfolio companies to play a very active role there, and we will look where it makes sense, we will also come in. But I would expect them to take the lead there. And I would say some of the areas that we've talked about, the other sectors, is where I think as a financial investors, we are best equipped to come in directly.
Tell me one thing, you had an year where you had $18 billion of divestment and $16 billion of investments coming in. How much of divestment happened in India, and how much of fresh investments happened in India from Temasek?
So, we don't disclose annually the numbers, but I would say investments, I've told you that the last 5 years, an average over $1 billion a year. I think last year was broadly in line with that. On the divestment side, actually, as we're looking to increase our exposure in India, our divestments actually were the only major divestment we had in India was Bharti Airtel, and like I said, we continue to retain a large part of that economic exposure. Beyond that, we had very little divestments.
So on a net basis, it was a net divestment, or is it? Because it was the biggest deal which happened last year.
Yes, but I would just say we don't disclose for individual countries specific. All I would say is that we continued a reasonably active pace of investments in India. And outside of Bharti Airtel, we had very small divestments last year.
Why is it that the Indian exposure or Temasek exposure to India is at 5%? You haven't been able to increase it beyond that, right? It's been 4 and 5 for last couple of years, despite the structural changes which has happened in the country. You have increased indirect exposure into India, but not directly into India.
Actually, our portfolio exposure to India as of March 17 is the highest that it's ever been. As a percentage, you're right, a couple of years ago it was 4%, now it's 5%. But that's a big shift. As our overall portfolio is growing, a number growing from 4 to 5 is not a small shift. We will look to sort of see if we can increase that, and actually we would like to increase that. It's really going to be a function of the opportunities we see. So overall, I would say, our portfolio exposure to India has been steadily increasing, actually increasing, fairly rapidly. We believe we're one of the largest financial investors in India, and it's something that we're looking to see how we can continue to sort of step up.
So, as the largest financial investor, what are the kind of challenges that you see while investing in India? And has it, over the last few years, have you seen those challenges being, taken care of by policy decisions?
So our own investments, I don't think we've really had many major challenges or obstacles. As a financial investor and the areas we focus on, frankly, policy has not been a major factor in terms of, whether we invest or not. It's actually been pretty okay for us. We've had no major issues. I think the challenge, if anything, has been finding the right opportunities that meet our value test and that are in line with our strategy. Some years we find more and we end up investing more, and some years we don't find as many. But that's fine. I think from a long-term perspective, I think we can see a steadily increase in our exposure in India. And year to year, there will be fluctuations depending on opportunities, both on the investment side and the divestment side.
Finally, briefly, we spoke about the earnings, growth expected in emerging markets and in developed markets. When you look at India, do you expect earnings growth to be in double digits? Because in the last few years, we start the year with high earnings expectation, and by the end of the year or mid of the year, we are just downgrading it to half. Do you see that growth projections this year to be sustained, given the fact you have lots of stuff, disruptions or structural shifts happening in the economy?
Yeah, as I was saying, this is one of the first few years, in fact, first year in a number of years, where globally in most markets, in the mid-year, you've not had earnings downgrades. India, you're rightly saying, is going through changes this year. So what will be the short-term impact of GST? Is it going to be disruptive for a few months? Will that have an impact on earnings? I don't know. It seems to be a relatively smooth transition, but we will know only in the next few months. So it's very difficult to say how earnings will play out this year. I think the market valuation and the rally is counting on the fact that you see an earnings recovery. Having said that, if there's just one-time issues around transitions, I think the market will be willing to look through that. What's going to be more important is the earnings growth we see over the next 2 to 3 years. And because I think we're at the beginning of a recovery in the earnings cycle, which should last for the next 2 to 3 years. And actually, that's what's going to be important. Because I think the market valuations are factoring that in. And one-off disappointments, I think people can be comfortable with. But the trend has to be in that direction.
Rohit, thank you very much for joining us on Bloomberg. Thank you.
Thank you very much.